Seen a healthy recovery in house sales and prices over the past 4 years. This is on the back of record low interest rates and growing stock shortages. In fact, leading real estate players such as Pam Golding Properties and Seeff are reporting sales turnovers near boom levels. But the current price growth of around 6 to 8% a year is out of sync with an economy that is growing at less than 2%. So, FNB property strategist John Loos joins me this afternoon to chat about where property prices are and what trend we can expect going forward. John, as always, thanks for coming in.
It's a pleasure, Devon.
I want to look at the global picture first. Yeah. Globally, there seems to be a concern that the bounce back from the 2008 crisis was a big one, it was pronounced. And in some countries, we might even see this bubble burst. I mean, you look at Canada, you look at New Zealand and Hong Kong, for example, those prices are quite high, aren't they?
They are. Ours too. There's no getting away from it. If you look back at recorded history, the oldest house price index being the ABSA one, which has gone back to the mid-60s. And in real terms, house prices are very high by those recorded historic standards. I think at some point it needs something of a downward correction, but it's probably not going to come just yet. Yes, that's the reality, and I think what we have to, I would be concerned. I think the healthiest situation for us would probably be for the Reserve Bank to gradually take interest rates up. At the moment, I don't see any major speculative activity in the market or buyer panic when people fear that prices are going up too fast, and so we need to get in now, otherwise we won't be able to afford it. There's nothing of that at the moment in there. But we have been, price levels where they are now at in real terms have been supported by abnormally low interest rates in this country, an abnormal stimulus because of an abnormal crisis economically. Very unbalanced economy where domestic expenditure well exceeds national income. These imbalances at some stage have to be restored. Fiscal deficits have to be narrowed. So it's an unbalanced economy, an economy living well beyond its means, which is supporting a relatively balanced housing market at the moment. But when you balance the economy, I believe at that point, you've probably and get to higher normal interest rates by our levels, you probably have to see something of a gradual downward correction in real prices.
All right, so as we move on this path of balancing in the next few years, what happens to the current price growth? We're sitting at 6 to 8% at the moment. Where do we go to, and what shape does it take in the next few years?
Well, I think firstly, we might go, price growth might go up, although I don't expect massive double-digit inflation or anything like that. But what we've had for quite some years is gradual demand growth since 2008's bottom, but very little growth in the supply of new stock. We've had building activity, it slumped after 2007 and has broadly moved sideways at much lower levels for a couple of years. What we're seeing now is building confidence rising sharply. We're seeing new building plans passed, in the third quarter, about 20% up roughly. The signs are there that we're going to have significantly higher building activity for 2015 and building completions. And that starts to alleviate these supply constraints which have been keeping prices inflating at sort of higher single-digit figures. And then possibly you could go down to lower single-digit inflation, I believe, past 2015, below CPI inflation, and then you get this gradual real house price correction. I think that's how it would probably come. So it's not some sort of crash necessarily, but a gradual correction over many years, such as what happened in the 80s and the 90s.
Okay, I want to just shift focus now and talk about perhaps the biggest frustration this year for anyone living in the house, whether he owns it or not. The blackouts from Eskom, the load shedding from Eskom. It's hard to believe that load shedding and this eventual or imminent program of load shedding as we move into the year will not affect property in any shape or form. What's the connection there?
Well, I think our electricity constraint does. Load shedding doesn't have a direct impact on property values. We're all the victims of load shedding, no matter what. You can't escape to some area where it doesn't happen, really. But the lack of electricity supply capacity has negative economic impacts. It must do. I'm sure of it. And that means it limits our economic growth rate, which limits employment, which limits household income growth, and that is the purchasing power for property. So you would think it would have some limit or some limiting impact on growth in demand for residential property. It can then, though, also have a supply impact. And that is, I mean, how many more developments can we have? How much can the councils, the city councils approve in terms of new developments without, with a limited electricity supply capability? I'm not so sure of that one. I have heard developers muttering about it's difficult to get approval, and that might be part of the reason. Or you might have to go for the solar electricity and some alternative which may up the costs. So it can have some supply constraint. Difficult to know to what extent it is. But I think overall it's a negative, because it has a negative economic impact. It contributes to negative investor perceptions. It contributes to possible ratings downgrades. And so, yes, I mean, we're an energy-dependent economy, and if you want to attract investment and more rapid economic growth, you've got to have ample supply of it. Anything that hampers the economy should probably overall be negative for property, I would think.
Yeah. Just final question before you go. You take a look at the health of the consumer. We just saw retail sales going up. People are shopping, they are buying. When we look at the health of the consumer and that same consumer applying for home loans, what's the situation at the moment, and what can we take from it?
Well, I think the consumer health is improving gradually from early this year. I don't expect any fireworks in terms of demand growth either for residential property or retail sales. But we have had an economy where that after the strike disruptions of early this year with a contraction has gradually been growing faster. And that means faster disposable income for households, a little bit faster employment growth, and so you should see purchasing, retail growing a little bit faster. But a lot depends on our labour relations situation and our electricity supply not to disrupt the economy in a big way again. If that's not the case, we do expect slightly better economic growth and consumer demand growth for next year.
John Loos, property strategist at FNB, thanks indeed for your time.
It's a pleasure.
Now we'll take a look at some international business news.